Good afternoon, everybody. My name is Zubair Khan. We are about to start our webinar. We are waiting for participants to join us, and at the top of the hour, we'll get it started. So if you've already joined us, we're just taking a few minutes to let everybody log in, and we will get started exactly at 3 p.m. All right, welcome everybody to today's webinar on the economy and the markets. This webinar is being sponsored by Azzad Asset Management. Many of you may already know of us or work with us as clients. For those of you who don't, we are a wealth management firm based out of Falls Church, Virginia, with clients across the country, and we specifically work with providing comprehensive halal wealth management solutions to our clients. This webinar is something that we hold from time to time, but we found it would be especially relevant given the current events that are happening throughout the market and the economy, especially with all of the news regarding inflation and recession worries, and also the current market decline and other global events. So we wanted to take this opportunity to share with our clients our perspective, as well as clarify what's really going on for investors. So if we can just move to the next slide. My name is Zubair Khan. I'm a financial advisor at Azzad Asset Management, and I'm also a part of the investment committee. I'm joined today by Joe Cortese. Joe is a partner at FIDUCIENT Advisors. FIDUCIENT works as our outsourced chief investment officer. Before I hand it off to Joe, I just want to clarify a few things for everybody. We want to try and make this as useful to you as possible. To that end, we're going to be recording this webinar, and if you would like a copy, we will send it to you upon request. Additionally, we are going to open this up to a Q&A at the end after Joe's prepared remarks. So if you have any questions, please take a look at the bottom of your screens. There is a Q&A button you can tap on and type in your questions there. So please, ask as many questions as you can, and we'll try to get to as many as possible. I'm going to hand it over to Joe. Joe, thank you so much for joining us, and please introduce yourself.
Thanks, really appreciate it, Zubair. Good afternoon, everybody. Thank you for the time this afternoon. I really appreciate the opportunity to share our latest insights and thinking with you, of course, timely given the volatility we've seen in markets of late. So we'll talk about some of the drivers there and our outlook for the remainder of this year and kind of how we can navigate this volatility in an effective manner. As Zubair said, my name is Joe Cortese. I'm a partner and a senior consultant with FIDUCIENT Advisors. We are based out of Chicago, Illinois. We have a few offices across the country, and I'm one of the leaders of our outsourcing practice, where we work with a number of firms like Azzad. But for those of you that don't know, we are an independent investment consultant, so we have no product other than the oversight consulting services that we share with our clients. We have end clients as well. We work with large institutional investors like corporations on the retirement plan side, nonprofit organizations, foundations, university endowments, family offices, high net worth investors. And the solutions that we provide our partner firms like Azzad are the same solutions that we utilize on behalf of our end clients. So we are eating our own cooking, as we like to say. We oversee about 275 billion in regulatory assets under advisement for those end clients. And then in our outsourcing practice, we work with about 60 firms like Azzad and others. And they collectively control an additional 200 billion or so that we're helping advise on. And we're able to do this work because we have a large, robust, dedicated research effort. We've got about 40 folks that participate in our research effort. We have 40 CFAs on staff, chartered financial analysts, if you're familiar with that designation. And many of these folks have no client-facing or revenue responsibility. In other words, their sole job is to research financial markets and diligence and approve the investment options that we're going to use for clients and portfolios. And again, all of those resources are made available to our partner firms like those at Azzad. So hopefully that provides a little background on our firm. I'm going to jump into some presentation remarks now. Let me just make sure I'm sharing my screen correctly here. Zubair or Josh, please let me know if you're not seeing this. So, of course, one of the main drivers of the volatility we've seen in markets of late is this increase in inflation, as you can see here. Very substantial, elevated rate of inflation really began at the end of last year. The March year-over-year inflation reading was 8.5%. It's about a 40-year high. So again, clearly running very hot, much hotter than we would like to see it from an economic perspective. The reading in April was a little bit less. It was 8.3% on a year-over-year basis, but it was higher than expected. The expectations were for an 8.1% reading. So inflation's perhaps not falling as fast as market participants would like to see it begin to start falling here. There are a couple of interesting dynamics that we would point to, though, in terms of this inflation. And at this point, there's a lot of comparison to this time frame in, say, the late 1970s, early 1980s, for example, where we had a significantly higher rate of inflation and inflationary shock. At this point, it seems kind of unlikely that we will repeat that type of an environment. And part of what's causing this inflation, obviously, is coming out of COVID and the lockdowns that took place throughout 2020 and into 2021. What you see when you look at the underlying inflation data is a bifurcation. And what we mean by that is we see tremendous inflation on the goods side of things, whereas the services side of things, the inflation readings are much more benign. So what do I mean by that? Well, think back to 2020, when in most cases we were locked down for a while. We couldn't do experiential things like go out to dinner, travel, stay in hotels, go to movies. All of those sort of experiential opportunities we weren't able to do that. And so what happened was consumers started to spend more money on the goods side of the equation. We started to buy more stuff because we were taking the money that we were spending on those experiential type things and spending it on goods. Well, so that caused some of the inflation because businesses just hadn't forecasted that type of a spike in demand on the goods side. So of course they have to charge more for increased demand. And then you layer on top of that supply chain disruptions as it relates to lockdowns in China and other areas of the world that manufacture a lot of goods. So you have a reduction in supply at the same time when you had a increase in demand on the good side. And so that really drove prices up on the good side. The thought here is that in the second half of this year, we should see some of that start to abate. And that's why, as I mentioned, the expectation for April and beyond is that inflation should start to fall a little bit. And that's as some of those dollars that were being spent on the good side are now being spent on the experiential side of things. As the economy opens back up, we can go out to eat again, we can travel again, we can get on airplanes again, we can stay in hotels again. That should alleviate some of the demand pressure on the good side of things and hopefully help alleviate some of this inflationary pressure. Of course, there's a lot of inflation, or I should say a significant portion of this inflation is also driven by an increase in energy costs. That has to do with a lack of investment here in the US, as well as what's going on with Russia and Ukraine. And that's gonna persist for some period of time as well. So we've got some time to go here. We've got some ways to go here, but again, it doesn't, at this point, it doesn't look like this is going to be a runaway inflationary environment like we saw in the late 1970s. And Zubair, if there are questions that come in, feel free to interrupt me and just point out those questions as we go if we'd like to keep this conversational, but otherwise I'll just continue forward. So the good news is, though, if we look at longer term inflationary indicators, they remain much more benign. This is a market observable 10-year break-even inflation rate. So this is a data point we can observe in the markets, and it's basically telling us if we put today as the sort of the start date and we go forward 10 years, and then we look back over that 10-year period of time, what is the market's expectation for the annualized rate of inflation? And the good news is it's still below 3%, about 2.8, 2.9% is the market expectation for 10-year break-even inflation rates. So again, this is a market observable rate. This is thousands, millions of market participants kind of putting their money where their mouths are, for example, and kind of betting, if you will, that inflation over the next 10-year period is going to be much more in line with long-run historical averages versus the 8.5 or the 8% that we're seeing today. So this is something that we can take a little bit of solace in. Another reading that we look at, market participants can formulate expectations in the market for what the Fed funds rate is going to be at the end of the year. So as we all know, part of what's causing some volatility today, particularly in the bond market, is the Federal Reserve, is raising interest rates. They recently raised the benchmark Fed funds interest rate by 50 basis points from essentially zero. So it's now about 1% or so. And the expectation is the Fed is going to continue to raise interest rates throughout this year. It's anticipated that in June, the Fed will hike the Fed funds rate by another 50 basis points. And then throughout the summer and into the fall, the market expects 25 basis point increases at the following meetings later this year. But what this is looking at is, okay, like in terms of at the December 14th, 2022 meeting, so the Fed's December meeting, what are the expectations for the Fed funds rate at that time? And as you can see, close to 90% of market participants expect the Fed funds rate to be about 3% or lower. So where are we today? Again, we're at 1%, meaning that we've got a little ways to go here, but the market is not expecting a 4% Fed funds rate, a 5% or a 6% or a 7%. Said differently, again, looking longer term, looking out over a longer time horizon, we expect this inflation and this interest rate hiking cycle to be maybe a little bit more benign than it might feel like at this particular point in time. Looking at another view, so this is expectations of the Fed funds target rate into 2024. And as you can see, we do expect the Fed funds rate to continue to rise throughout this year. Market participants expect it to hit a terminal rate or sort of the natural rate of about 3%. And once it gets there, it's not expected to increase any further. And in fact, it's maybe expected to decline a little bit. Well, what's happening there? You know, the reality is that typically when the Fed starts hiking interest rates, the economy does slow down. I mean, that's the goal the Fed has. They want to take some of the air out of this inflation, and in doing so, in order to do that, they're going to raise interest rates, which curtails economic activity to some extent. So there's a big question about, will we have a recession or not? Or will the Fed be able to engineer what's called a soft landing, where they're able to raise interest rates without tilting the economy into a recession? I'll show you some more data on this as we go forward. But that's a question that's looming out there for market participants is if we're going to end up in a recessionary environment, and expectations are telling us that the economy is likely to slow. Now, whether or not we actually get into a recession or not, that remains to be seen, but expectations are things will slow as the Fed continues to tighten monetary policy here. So let's take a look at first quarter GDP report. This was basically our first read of economic activity within this Fed tightening cycle. You can see that on an overall basis, real GDP came in at a negative 1.4% for the first quarter. So actually a contraction in the first quarter of this year. Well, what's driving that? It's a little bit interesting. Again, if you look under the hood, the numbers tell maybe a bit of a different story than the overall takeaway. What this was really driven by was a massive increase in imports. So because we're not, because of the supply chain disruptions and those sorts of things, the U.S. is having to import a lot more goods and some energy right now, which you can see a pretty significant spike there, 17.7% increase in imports during the first quarter of 22. Now, this is actually functions as a negative or a minus sign when you're computing GDP. You add up all of these numbers, you subtract imports, just the way the formula works out, and that gives you your overall GDP reading. So when we look at other things like consumer spending, which equals about over 70% of economic activity in this country, it was positive for the first quarter to the tune of about 2.7%. That's good news. You see some declines in federal spending, state and local spending, a decline in exports, again, the massive increase in imports that I mentioned, and some fixed investment within non-residential and residential areas of the economy. And then again, overall, that negative 1.4%. But the point here is that had we not had this massive increase in imports, the GDP report for the first quarter could have been positive, frankly. Now, here's the other side of this that we need to take into consideration. The technical definition of a recession is 2 consecutive quarters of declining or contracting economic activity. So we're 50% of the way there, just numerically, right? We had first quarter 2022 with a negative GDP reading. If these imports stay high and tilt the second quarter GDP reading into negative territory again, like it did in first quarter, technically we're in a recession right now. So just pointing that out, that we could enter a technical recession as of the second quarter of this year. Not sure yet how it's going to play out, but that would be the technical definition of a recession. And the question then would be like, how long does it last? How deep does the recession go? Those sorts of things. And the good news is today, it's highly likely that we would have a sort of a crisis type recessionary environment that we saw in 2008, the Great Recession, the financial crisis. There just hasn't been as much excess built up in the system, particularly in the banking system, which was the real driver of the Great Recession. That just doesn't exist today. And also, consumer balance sheets remain relatively strong. Consumers are still spending, as we saw here. They still have a lot of money saved up from COVID, those sorts of things. The housing market remains relatively strong. So it's hard to have a deep recession with that type of a backdrop. We could have a mild recession and maybe it lasts a while, but again, it's hard to have a really deep recession with those type of factors in place. So if we look at some surveys out there and say, well, what does the market think? Of course, about 57% of market participants do believe that we will end up in a recession as a result of this Federal Reserve tightening cycle. 33% say no, 10% don't know. But we like to look at the data, and the data is important. Of the past 13 rate hiking cycles, 10 of them have ended in recession. So just from a probabilistic standpoint, it is highly likely that our economy will contract as a result of this Federal Reserve tightening cycle. So we shouldn't be too surprised by that, because just using history as a guide, more often than not, that is what happens. But the hope is that we can kind of engineer a bit of a soft landing here. The Fed will be very careful about tightening too much, and maybe again, if we do have a recession, it's likely to be on the milder side as opposed to a really deep crisis type recession that we've seen in the past. The other good news to point to is corporations are still doing relatively well. They're making money. This is as of April 29th. We looked at first quarter earnings results. As of the 29th, 55% of S&P 500 companies had reported earnings results. And the good news is that 80% of those companies that had reported had beaten earnings per share estimates. which is above the 5-year average of 77% of reporting companies beating earnings per share estimates. So that's good. More companies are beating the estimates that Wall Street has for them and analysts have for them. The flip side of that is they're not beating by as much as they typically do. Historically, when companies beat earnings expectations, they beat by about 9% in terms of the profits that they're earning versus expectation. Within first quarter, it's been about 3.5% or so. So yes, more companies are beating expectations than sort of the recent average, but they're not beating by quite as much. And so they're just not, they're not making quite as much as, above expectations as they have in the past. But again, all told, corporations as a whole are still doing relatively well and are still able to tolerate this inflation, in many cases pass along some price increases to consumers, which we don't like, right? We all feel the higher prices every day, particularly when we go fill up our cars and those sorts of things, or go buy food at the grocery store. But the good news is that the economy, seems like it's continuing to chug along here, even though we're dealing with what is some elevated inflation at this point in time. Let me pause there. Zubair, are there any questions we should get to at this point, or should we just continue on?
Yeah, Joe, we've got a question. I'll try and answer it myself and also ask for some of your insights on this. So an anonymous attendee asked if inflation started at the end of last year and 8.1% is expected, and the Fed interest rate rise is no surprise. As a customer, I expect my managers, the manager might ask us to help avoid the negative, or I guess the bad side effects of this. So, I think, for our at Azzad Asset Management, there's a couple of things that we try to do to sort of look at these things that are being forecast and adjust our portfolios. So number one, we work with companies like FIDUCIENT to update our capital market expectations and then allocate our portfolios in accordance with those expectations. So, for example, we may allocate more to our international portfolio one year and move a little bit out of it, move it to more large cap holdings in our portfolio as opposed to mid cap or small cap. So we make those sort of allocation adjustments, and then the portfolio managers that are managing those portfolios are obviously always looking for companies that are going to stand the test of time. We want managers at Azzad specifically to invest in businesses that have solid balance sheets, have large market share, good products. But they're also, these managers are also looking tactically to make sure that they're in companies that are going to not be so adversely affected by these markets. At some point, there's nothing you can do. There's certain periods in time where everything is sort of going down, and this may be one of those. And other times, you may see some negative performance in your portfolio, but that may only be short term. You've got to think of investments as a long-term thing, and a stock that may not be performing as well right now in your portfolio over the long term may be an excellent stock and just might not be in favor. So Joe, what do you think about that?
Yeah, I agree with all of those sentiments. There's a couple of other points I would make. Yes, we're sharing a lot of information with you, talking about interest rates and the economy and will we have a recession or not. The ironic part about this is right now it's not actionable in investment portfolios. And we have to be really careful in this environment to not do things in portfolios that are really going to negatively impact the long-term returns that we're shooting for when we build these types of portfolios. So what do I mean by that? Well, first of all, let's think about, well, okay, if you wanted to say, okay, we're going to go into a recession, we need to do something in the portfolio. What do? Do you sell equities and go to cash? Well, that's a suboptimal outcome because cash is probably the worst investment right now because of where inflation is, right? So you're losing purchasing power at the fastest rate in 40 years if you're holding cash. So that's not a good option. You could look at maybe other particular areas within the markets, but then you're ending up overweighting specific areas, specific sectors, making explicit bets on specific areas of the market. So really the thing to do right now, and what's critically important, is to maintain a broadly diversified approach simply, simple, not having all your eggs in one basket type of a strategy, and adjust portfolios along the way. And we will work with our partners at Azzad to help determine when we need to make adjustments in portfolios and what those adjustments should be. We run models to look at portfolios, expected return, expected volatility, historical risk return statistics. We run those models continuously behind the scenes, and we have a formal process that we run as of the end of every month. And so we look at month-end data, we look at how markets have moved over the previous month, and we use our models and some judgmental overlay to say, okay, have things moved to an extent that we need to make shifts in portfolios? And the reality is that markets just haven't moved enough on a relative basis at this point in time to cause us to make any shifts right now. I venture a guess to say that we will likely be coming out with some shifts, perhaps in June, perhaps in July, depending on what, if markets continue to decline from here or stay low. We likely will need to make some adjustments in markets based on our modeling and our capital markets and our portfolio construction process, but we're just not there yet. The other thing I would say is, even if you did say, okay, I get it, I still want to try to, de-risk my portfolio or something like that, I'm going to take some assets out and put it in cash. Again, not a recommendation and a suboptimal outcome, but the question is, okay, you take some assets out of your portfolio, then you put it in cash. Well, how do you know when to get back in? Do you wait until the market's down another 10%? Well, maybe it's going to go down further. Do you wait until it's up 10%, but then you've missed out on 10% of the recovery, right? So in all the data that we look at and that we study, it shows us that investors that try to time markets end up with lower long-term returns overall. Because the ironic part about bear markets and difficult markets is the biggest up days, the biggest single best days in, for example, the S&P 500, occur during difficult markets, occur during bear markets. And if you're not in the markets at those particular times, you're missing out on the best days, and missing out on even the 5 or 10 best days in the market over a long period of time can drastically reduce the long-term returns in your portfolio. So our process is to maintain a broadly diversified approach, even through difficult markets, and to tweak portfolios along the way as we go.
Joe, another question. If recession is likely, what are the recommended changes to my current portfolio? And this client specifically has a mild, moderate aggressive portfolio.
Yeah, so again, we're not recommending any changes today. We're watching it very, very closely, retesting our capital market forecast assumptions on almost a daily basis at this point. And again, likely there will be some changes later this year. But the option, frankly, the option is if equity markets continue to decline, that's when you step in and actually add to that side of the portfolio, add to the risk side of the portfolio. So you sell a little bit of what's held up better, and you buy that asset that has declined in value. It's essentially on sale, right? We all want things to be cheaper. We want to buy when things are cheap. It may not feel good. And in fact, it doesn't feel good. And that's frankly, many times the best time to buy, when it feels really bad. But that's how the process works. So the option, the move would be, if markets continue to decline from here on the equity side, we may be adding to that portion of the portfolio at some point in the not too distant future.
Yeah, and I'll add to that, Joe. There are a couple of things that I would recommend to any client right now. Number one is to just review the risk, the level of risk in your portfolio. If you feel like you're not happy with how far your portfolio has declined, you're not happy with the volatility, it's a good time to talk to your advisor and make sure you're in the portfolio that's at a risk level that you're comfortable with. Because I think what happens is people, when they invest in up market, their risk appetite is fairly high, but when a market goes down like it has been recently, they change, their opinion changes on that. So it's a good time to look at that. And also, if you have any short-term expenses, any major purchases that are going to happen the next year or so, put that in cash. Increase your emergency reserve in cash. You don't want to play with that money. You want to make sure it's there when you need it. But like I said, long term, you've got to relook at the risk in your portfolio. That may be an adjustment you want to make. We'll ask one last question before we continue with the slide, and then we'll have more Q&A at the end. What do you think about consumer debt rising? I guess there's CPI is increasing. So does that consumer debt rising have any Do you have anything to say on that, Joe?
Yeah, I mean, it can be a concern. We're not there yet. As we saw with the first quarter GDP report, consumer appears relatively healthy at this point. But yes, credit utilization is increasing. More people are putting more spending on the credit card, so to speak, and obviously that is unsustainable in the long run. So if wages don't sort of start to come up here a little bit and maybe keep better pace with inflation. I don't think wages are going to rise by 8% or anything like that. But if they start to keep better pace with the increase in inflation, then that'll help the consumer. But it is something we're watching closely because, once you see higher credit utilization, that can sometimes lead to a slowdown once that additional credit is tapped out and people just don't have more money to spend. So it's a concern. It's not impacting things negatively yet, but it's something that we're watching closely.
All right, Joe, we'll let you get back to the presentation. And people, if you have questions, please feel free to write them down, and we'll get to more at the end of the presentation.
Sure. Okay, let's just take a look at the yield curve, where yields are. And this, again, is as of April 29th when we put the slide deck together. You can see 12/31, here are yields, 1/30 at the end of January, end of February, end of March, and then April 29th. So as you can see, this is just a graphic representation of the increase in interest rates that we've seen, and also a very steep yield curve from about, from 3 months to 5 years. Yeah, very steep upwardly sloping yield curve, which is good. The issue is when you look further out, the yield curve is very, very flat. And in fact, we do have a little bit of an inversion here from 5 to 10 years, meaning that the 10-year yield is a little less than the 5-year yield. The vast majority of the time, yields are upward sloping because of the additional risk associated with longer periods of time. So the demand for that, the price demanded for that money from a lending standpoint is a little bit higher. So a lot of people look at this and say, well, whenever the yield curve inverts, there is a recession. And that's typically true. The reality is that yes, anytime we have a recession, it has been preceded by an inversion of the yield curve, but it can also be a false indicator, meaning that there are periods in time where we've seen an inversion of the yield curve that haven't also been followed by a recession. So it's not a one-for-one correlation. And then the other part about it is again, it's impossible to predict when you first see the yield curve inversion. If we do end up in a recession, what is that time frame from when the yield curve inverts to when the recession starts, and how long the recession is? And the reality is that if you look historically, from the time the yield curve inverts to when the recession actually happens, looking backward, the returns across financial markets are actually quite positive to a strong degree. So again, if you're trying to trade this type of information, you're more often than you're more likely to hurt yourself versus help yourself, as opposed to remaining invested and sticking to the process through time. Certainly, it's been a difficult market in the bond market. These are some returns here for the bond market across different areas. TIPS, or Treasury inflation protected securities, down about 5% for the year. Your traditional U.S. corporates, treasuries, agencies, about 9.5%. Municipal bonds down about 7%. High yield down about 10%. High yield muni, down about 10%. High yield corporates down about 8%, and then global bonds down about 11%. So no doubt the increases in interest rates are having a negative effect on returns. The flip side, though, is on a forward-looking basis, it's better to have higher rates, right? You get for those investors that do utilize fixed income in a portfolio, and I realize a lot of folks don't here, but it's healthier to have higher returns looking forward, higher yields looking forward, because returns are better, and it signifies a healthier economy than when yields are at really emergency low levels. Here's how the equity markets have done this year, so you can see additional information on the sell-offs that we've seen. Dow Jones holding up better than the S&P 500 and the NASDAQ, of course, that's been most negatively impacted. Today, through yesterday, the S&P 500 is down about 14%. Developed international stocks are also down about 14%, and emerging market equities are down about 16%. A couple things that I think are interesting here to note. Yes, we're having a difficult year, no doubt, and it's painful and it doesn't feel good, and I really do not like delivering negative news as an investment consultant and strategist. However, if we look back over the last 3 years, even with the declines that we've seen up to yesterday, the S&P 500 is still annualizing at just shy of 15% over the last 3 years. That's almost double the long run historical average for the S&P 500. And even if you extend that period out to 5 years, the S&P 500 is still annualizing at about 14%. So we've just been through a period, the last 3 years in particular, have been historically strong in terms of equity market returns. Not really that surprising that we're going to let a little bit of air out of that bubble here this year. Things just got too expensive and we need to rationalize it a little bit. But that shouldn't scare us out of our investment strategy. This is markets doing what markets do and normalizing valuations, normalizing prices, reversion to the mean, if you're familiar with that concept. It's the most powerful concept in investing in financial markets generally. And we do need to, a little air needed to come out of that, what were really strong markets. But again, taking a longer term perspective, you've still enjoyed, if you've been invested over that period of time, you've enjoyed very strong gains over the last 3 and 5 years. And I think that's a really important point to keep in mind here. We basically just covered this. This is equity market returns. I just gave you updated figures. This is through April 30th. So the information that I just shared is a little bit more up to date than that. The other point we'd like to make here is, while this period that we're living through may result from drivers we haven't seen in a long period of time, most of us probably on this call didn't live through the inflationary environment in the late 70s and early 80s, or we're very, very young, right? We haven't seen a war in Europe to the extent that we're seeing today since maybe World War II, right? It's very scary. The point is that the world is always an uncertain place. And a good article I read last weekend talked about a person that had been born in 1900 and lived 100 years to the year 2000. Think about what that person saw in their 100 years. You know, they saw the First World War. They saw the Spanish flu. They saw the Second World War. They saw Vietnam. They saw presidential assassinations, all sorts of bad things that happened over that time. Yet the equity markets still returned on average, 7 or 8%, depending on how you look at it over that entire period of time. So my point is that, yes, the drivers may be different today, but the market's reaction is not unique here. This is, right in line with what we see when we look historically across financial markets. And this chart does a good job of illustrating that. So the blue bars are market returns for every year going back to 1980. You can see that the majority of the time, the markets finish in positive territory for the year. But these little dots are the drawdowns, the intra-year drawdowns that take place. So you can see that even when markets are typically positive in any given year, there's always usually a drawdown. And that mean, or that sort of average drawdown across these 40 years is about 9.3%. So we expect nearly a 10% decline in equity markets every year. That would just be sort of the average. However, the mean total return, the average total return for any given year is still about 13.5%. And again, that just hopefully provides some context to say that, yes, this environment is difficult. It's nerve-wracking. It produces a lot of anxiety, not only for us in the business, but for you as clients, and perhaps more so for those of you that are not in the business. But again, it is not unique. These are the types of things that we see happen and the types of reactions we see within financial markets throughout history. So we are not in uncharted territory as it relates to market reaction here. Now let's dig into that data a little bit more detail here. This is a chart that talks about past declines in the S&P 500 since 1945, since World War II. You can see that there have been 84 occurrences where the markets have declined between 5 and 10%, 29 occurrences where the decline has been 10% to 20%. 9 times the S&P 500 has declined greater than 20%, but not greater than 40%. And then 3 times throughout that period, the S&P 500 has lost nearly half of its value. And again, yet long-term returns still remain very robust. The other point about this is if you look at the time frames here, average length of decline. In this case, it's 1 month, in this case, 4 months, in this case, 11, in this case, nearly 2 years. So that's why you can't time these things, because you're likely going to get it wrong because they play out over long periods of time. And then in terms of the time to recover, you're looking at a month for the shortest declines. You're looking at 4 months for the sort of 10 to 20% declines, over a year for declines of 20 to 40% in terms of recovery. And then if we have a really bad market, it can take multiple years for markets to reach recent highs. So again, it's very hard to time these types of environments. expanding this out a little bit, looking at declines from 1950, and here's all the different declines. Here's the extent to which the market declined: 14%, 15%, 11%, 15%, so on and so forth. And then the duration of these declines in months. So again, just taking zooming in on the data that we looked at on the last page for a second longer. Looking at it another way. So when did the markets peak? When did they reach their bear market low? What was the average, or sorry, the amount of decline in each of these? So you can see negative 28, 21, 22, 28, 20, so on and so forth. On average, in bear markets, they decline about 34, 35%, the median being 31%. The duration on average of bear markets lasts just over a year. Typically, bear markets coincide with a recession more often than not, as we talked about recently. So probabilistically, we may be looking at a recessionary type environment. But here's the kicker. Return 1 year after reaching the low in the bear market. Look how strong these are. On average, 42% increase in the S&P 500 after reaching the bear market low, and then time to regain the peak. So this is the problem. You know, if you miss out on that low and you try to wait until you feel good about getting back in markets, it's highly likely you've missed out on a major portion of what is ultimately going to be that very strong gain coming out of a bear market. So again, just more information of why it's not actionable. And then just looking at, well, how do things work in inflationary environments? This is the rolling 12-month rate of inflation. You can see that when inflation is stable, 0 to 2%, 2 to 3, 3 to 4, 4 to 6, returns across fixed income and equities are typically pretty good. Of course, equities do a little bit better in environments where inflation gets a little hot. Both equities and fixed income, however, suffer when inflation gets too hot. And that's what we're trying to guard against today. That's why the Federal Reserve is trying to apply the brakes here a little bit as it relates to the economy and markets. So what's the sort of takeaway here? No doubt we've had a difficult year thus far in 2022. Keep in mind it comes after historically strong years in 2019, 2020, and 2021. So if you've remained invested throughout this period of time, you're still looking at very healthy gains in portfolios. Right now, this information isn't actionable in portfolios. We are not making shifts today. But again, as I said, if things continue in this manner, remain volatile, perhaps decline a little bit from here, we will likely be making shifts within the next few weeks in June or July. And we will keep our partners at Azzad updated as to when models are telling us we need to make changes, and then those changes will be reflected in portfolios. So all in all, we feel your pain. We know it's difficult. We know this type of an environment can produce a lot of anxiety, but hopefully you can take comfort in the knowledge that we've been investing with our framework for the greater part of 20 years. We've been through difficult environments, including the bursting of the tech bubble, the great financial crisis, the sovereign debt crisis, the energy crisis. Again, there's always things going on in financial markets, and our process has continued to lead to respectable long-term returns, hitting those goals and objectives that we set for these portfolios, helping us achieve our financial plans, and doing it with the least amount of volatility possible. So while things will bounce around a little bit here, please take solace in the notion that we have a process to help us get through this difficult environment. We know we'll be okay at the other end of it, and we'll live to fight another day. Let me pause there.
All right, Joe, thank you. So I have a question from Zachariah Arshid, and I hope I'm pronouncing your name correctly. So I guess the question is, Zachariah has some real estate property, and he wants to know, what do you think about the real estate market right now? Is it a good time to sell? Should he reallocate some of the gains he's made in real estate by selling the property and reallocating to some of the other parts of his portfolio?
Yeah, so great question. And I need to be a little bit careful here because I don't know your specific situation and circumstances. So I can make some general comments, but by no means am I, disclaimer, I'm not giving any direct investment advice here. What I would say is this, the real estate market has, just like what we talked about in the equity markets, has been exceedingly strong over the last few years, substantial gains in many areas of the country. Some of the areas coming out of that market as well. particularly as we see mortgage interest rates rise. 30-year mortgages are now approaching 6%. Last year they were still down around 3%, right? So they've almost doubled from here. That is no doubt going to slow down the real estate market. So, if it were me, I'd look at perhaps taking some gains within my real estate holdings, perhaps all, depending on, again, on your particular circumstance and situation. And then this would be a good time to begin to reallocate those assets to other areas of financial markets that have declined in value, namely the equity markets, so to speak. So that would be just my base level comment on those sorts of things. And then again, you'd need to apply your specific circumstances and needs to that type of a situation.
And if you're listening to the webinar and you have questions, please, again, use the Q&A feature at the bottom to ask your questions. We have another question from an anonymous attendee. What is the recommendation with cash holdings at this point?
That's a great question. It's something that we're talking a lot about with our clients and our partner firms. We would advocate getting that cash invested over a reasonable period of time. Again, cash is probably the worst asset today with interest rates and inflation rising, and you're losing out on purchasing power. However, we recognize that this is very volatile. So we would take 2 to 3 swipes at investing cash, maybe do a third today, a third in June, a third in July, for example. Don't string it out too much, because then again, you're missing out on potential gains in markets. So get invested in a reasonable period of time, but in order to mitigate a little short-term volatility, take a couple swipes at it. That's typically how we approach that type of a question.
Yeah, and just to add on to that, I mean, at Azzad, we usually recommend that clients keep at least 6 months worth of expenses in cash. It's good to have an emergency cash reserve and then invest beyond that. So, that way your funds are longer term. The longer term funds are invested, and the money that you need right away can be relatively safe. I have a question from Mustafa Tassur. I am not in the investment environment and was planning to start investing in the stock market. Is this a bad time to enter in the investment market now? What do you think, Joe?
It's certainly a better time than it's been in the last few years, right? We've seen declines in the equity markets to the tune of almost 20% today. So a little bit of a discount, a little bit on sale there, right? So yes, it's a good time. But again, I would consider taking multiple swipes at it, because things could decline further from here, right? So you never want to time these things, sort of full stop. So, I would look at what you're willing to invest today, and I would start to implement that plan over the next few months here.
Yeah, I mean, so yeah, Joe, so just to piggyback on that, like you said earlier, there's, you never know when the market is going to bounce back, and it usually bounces back very quickly. So it's good to stay invested. So what is the best course for those who are subject to minimum required distributions and portfolio shares are sold every month? Do you have anything you could say on that, Joe?
Well, the good news about that is if you are taking out a little bit every month, you're sort of dollar cost averaging out, if you're familiar with that concept. So it will have less of an impact on a portfolio if you were just to take a big lump sum at a time when markets were down. So I would stick to your plan there. And continue to, sort of execute that plan over time. Some other scenarios we look at in that environment, maybe not a good time to implement something like this today, but some food for thought for the future is if you have a certain amount you have to take out every year, perhaps take 3 months out at a time, right? Or take 6 months out at a time. So you do it, it's there, you know it's going to be there for your living expenses. You don't have to worry so much about short-term market fluctuations and those sorts of things. But the key is have a plan and stick to your plan. The best way to do it is to have a plan and stick to it over time, and that will produce the best outcome, as opposed to just trying to time it and say, oh, markets are up, I'm going to take some money out now, but then 6 months I need money and markets are down. That's not good. So having that plan and sticking to the plan is really the key.
Yeah, I think one other point is so that your requirement distribution figure is based on the value of your retirement account on December 31st of the previous year. So if the market goes down, it could potentially mean that you have less of a requirement minimum distribution for that year, which could be a good thing from a tax perspective. I think, do we have any more questions? If you have any more questions, please type them in now. We want to make sure we get to any questions you may have. I think you could alternatively press the raise hand feature, and we could call on you if you would like to speak during the webinar. Okay, Joe, I am not seeing any more questions. So I want to thank you, Joe, for joining us and leading this conversation. Also, I want to tell all of our attendees, if you have any questions and you're already a client of Azzad, please feel free to reach out to your advisor. You should have their contact details. If you're not a current client of Azzad, you can visit us at our website, azzadasset.com, and right on the homepage, there is a button where you can schedule a consultation. Feel free to use that and set up a time to speak with us. And like I said at the start, we will have this webinar recorded, and we will share it with attendees who make requests. So thank you so much, everybody, for joining us. And Joe, again, thank you for your help and the great insights.
Always happy to be here. Thanks so much for having me. Have a great rest of the day.
Bye, everybody.